Like my father passed the house to us without having to pay capital gain.
Welcome to Barry's Bites. Please join our host, attorney and financial advisor Chris Barry.
Let's say we bought the house for $100,000. Number of years go by, and now upon death, let's say it's valued at $300,000. And then let's say the kids sell maybe a year later and it's valued at $350,000. So the question is, what would be the tax consequences of this? The thought some people have is you bought it for 100 and then you sell it for 350, there's going to be $250,000 worth of capital gains. But that's not the case, because what happens is there's a step up in basis upon death for real estate and non-qualified assets. So when someone passes away, the new basis for any type of gains is going to be the fair market value at date of death. And so if the fair market value at date of death is $300,000, that's the new basis. And so now the capital gains that could be owed for the kids would only be capital gains on the $50,000. And again, it's not income. This would just typically be capital gains. And to clarify, we need to make sure that we pass the house or any real estate correctly through this process. So there's different ways to pass assets. One would be like adding a child joint to an asset. Another would be through a beneficiary designation, passing the house. We call these ladybird deeds in Michigan, where it's in mom and dad's name during their lifetime, but then upon death, it goes to whoever's listed as a beneficiary. And then the third way to pass assets would be through a trust. But if an asset doesn't pass through one of the first three, then it ends up going into probate. Everyone wants to avoid probate, so we don't want to rely on that as a way to transfer assets. But if it does go through probate, you do get step up. But unfortunately, you still have probate. So we don't want probate. We don't want to rely on this. So probate, bad, because it's a court process, it's time consuming, it's costly. But you do get a step up in basis. So that part's good. With a trust, so if it passes through a trust, like an asset protection trust or a castle trust or a living trust, you do get step up and you avoid probate. So that's a good way to do it. So trusts are good. Beneficiary designations like a ladybird deed, yes, you get step up and it avoids probate. So that's also passing a joint by adding one of your kids' joint. Guess what? No step up. So this is bad. So if you add your kid joint, then it's going back to the original basis that the property was purchased at. So we don't want joint ownership. We don't want to lose that step up in basis. So how do we transfer assets without having to pay capital gains upon death? Either through ladybird deeds, where you get step up in basis, or through a trust, where you get step up in basis and also you avoid probate. If you just leave it in dad's name, dad passes away, you go through probate, you do get step up in basis, but you still have to go through probate, at least 5-month court process. Plus, it's going to be costly. So again, how do you want to transfer assets to the next generation or to beneficiaries? You're either going to want beneficiary designations, more specifically that ladybird deed, or you'll want to utilize a trust. Both of those avoid probate. Both of those get step up in basis. And that goes for any piece of real estate. So we're not just talking about like your primary residence. That's for other pieces of real estate as well.